That identification of dividend growth sustainability is the most important part of dividend growth management, which is why I don't believe it can be done passively. Passive dividend growth investing is backward looking. And to vouch for the sustainability of forward dividend growth requires a forward looking approach. And our process is both qualitative and quantitative. It's certainly true that there's a lot of merit in looking at the history of dividend growth. It isn't super common that companies with decades of experience of growing the dividend year over year, the so-called aristocrats, that they are likely to cut the dividend, but it can and does happen, and in some cases, notoriously so. We have kind of famously gotten in front of a few of those, and I think it represents some of our better portfolio management moments in my career. But we have to look to the qualitative element of, do we believe this company is paying a dividend and growing their dividend joyfully, or do we think they're doing it against the will of management? Companies that pay a dividend but don't want to do so are a little less exciting to us than companies that there is a strong sense of alignment with management. And so we look to that qualitative element as well as the track record, the history, and then, of course, the obvious financial analysis. Overly indebted companies are more vulnerable to sustain their dividend for the very simple reason that debt has to be paid, debt service has to be paid before dividends to investors. And so, if a company's either debt to cash flow or debt to income, their debt to assets, position of the balance sheet of the company, these metrics matter a lot, as does the nature of their business model, the cyclicality of their revenue stream. So certain companies have more recurring cash flows than others. We love companies that tend to have very regular earning streams. I myself, working in wealth management, am very used to a regularity of an annuitized revenue stream because it's the way our business runs. We look to identify companies that oftentimes have something similar in their own business, recurring, regular, fee based revenues. Those tend to be really reliable dividend growers.